All right, I want to thank everybody for joining us today. Like I said, this is going to be recorded, and this particular webinar is a great option strategy, for lack of a better phrase, I guess. I think they're all great strategies, but this one is particularly good in the sense that for a newer trader or somebody that has a smaller account, this is a great one to implement as an entry level strategy. I still use this quite a bit. If you guys watch many of my recent daily market commentaries, I haven't implemented this strategy in quite a while because I've been very directionally biased. So for a while there, I was very short and caught the sell-off recently, and then got a little bit long, and it's come back. So I've talked about this several times about how the market, when it has these major gyrations, that it will tend to have a tendency to kind of settle down. And I kind of see that happening in the next couple of weeks anyway. I think that we've seen a major move. Market's kind of found a little bit of a resting place, or a comfort zone, if you will. And I don't see, although I see there's going to be volatility throughout the year, I think that this next couple of weeks it could settle down just a little bit. So this is why I think it's a great time to talk about this particular strategy that I'll go over here in a minute. But a couple of things to get out of the way. First things first, my name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. I've been trading my own money for over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your portfolios, and most importantly, take control of your own risk. I talk about this every once in a while. If you've got a financial advisor out there managing it, first thing I would ask him is, do you invest in ETFs or options? And if they say that those two things are too risky, well, at the end of the day, they're less risky than just trying to pick a stock. If you have an ETF, it has a bundle of different stocks in it, and you're not beholden to which direction one particular stock will go. So that would be a red flag right off the bat. But going forward, I've traded most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products and in all market conditions. As you can see there, that was a crazy day. One thing I got to go over here, any opinions, news, research, analysis, and other information contained here or material provided by ProTrader Strategies and or associates should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why I can't tell you that you should go out there and invest in Apple or short Apple is because I don't know your guys' risk parameters. I don't know what's in your portfolio. So a lot of things that I'm talking about could be counterintuitive to what you're already doing. So at the end of the day, it's up to you guys to do your own homework, and please remember, past performance of any trading system or methodology is not necessarily indicative of future results. Having that out of the way, this is going to be on an Iron Condor. And one thing I always say with these different strategies that we talk about, don't be a one-trick pony. Go out there and try these different strategies, but use a lot of different ones in your portfolio, because you don't want to just be beholden to one strategy, and one strategy isn't always going to work out every single time. So if you have a lot of different things going on in your portfolio, that's going to be a well-balanced portfolio, and you're going to have your most success when you implement a lot of different strategies. It doesn't mean that you can't have one that is your favorite. And going into this year, I guess, is probably the time where I've kind of gotten away from the Iron Condor, because I thought the market was at all-time highs, and there's going to be a tipping point at some time, and I kind of got away from this and started getting really short the overall market. So don't always just have one particular strategy. One thing with the Iron Condor is we are going to be looking at different types of environments where it's range bound, it's market neutral, meaning it wants to trend sideways. And you don't have to be a technical analysis kind of guy or be able to read the tea leaves of the charts. You know, you don't always have to have an opinion on the market to implement an option strategies or an option strategy. And the Iron Condor really fits with that. If you're kind of looking at something like, you know what, I really don't know what direction it's going to go. Well, an Iron Condor would be a good time to implement a strategy like that if all the other things are going to line up correctly, if you will. And one of those things that we really need to have is we're looking for high volatility. The only time that we're going to do this Iron Condor, and I'm looking at this Iron Condor from the sell side. I want to collect a credit for that. And when I collect a credit for something on the sell side of these option strategies, I really want high implied volatility percent. And the reason why is because when that volatility collapses, you really see theta come out of those option strategies, or this one in particular, and the theta is the time decay. What happens with volatility is it pumps up that theta and holds it up. It doesn't allow it to decay very quickly. And if you're not very familiar with how volatility affects theta and things of that nature, you can go to Pro Trader Strategies and check out the Volatility Crush webinar that we just recently did on that. That's a really good one to help you understand how volatility really affects the different Greeks of the option strategies. So we're really looking for high implied volatility percent for this type of strategy. And if you guys have watched any of this go on in the last few weeks, you notice that implied volatility has been really high and it's really starting to come off rather quickly right now. And this is building out from a strangle. If you guys know, a strangle is selling a call and selling a put, but with this, it's going to be a strangle with defined risk. And it's kind of like you're adding a call spread with a put spread and you're implementing it at the same time. And here's the risk parameter on a short put spread up here. And, you know, I just built this out myself, so pardon the crude nature of it. But a put spread, this is your risk parameter, and a call spread, this is your risk parameter. What happens is you kind of jam those together and you get your Iron Condor, and this is the risk parameters for an Iron Condor. If it's in a low IV short Iron Condor, this is what it's going to look like. Trevor, you're not getting any sound? I think some other people said earlier they were. It looks like it's working to me. So in a low IV environment, it has a tendency to become more pitched and has a narrower range on the upside. When you have the high IV, all right, good. Trevor's got sound again, good. All right, so in a high IV short Iron Condor, you can see that this is a little bit longer on this upward band. And that's really what we want to have happen. The reason why is it gives you a lot more room to be wrong. Over here, your break even is going to be a lot tighter than what your break evens would be on a high implied volatility short Iron Condor. And one caveat to implied volatility is that it is generally overstated, you guys, because when it pumps up, it will contract, and when it contracts rather quickly. And that creates a type of scenario where implied volatility is what is implied going forward contracts. So it has a tendency to overstate. It's not always true, as we've seen in the last couple of weeks, but rest assured, when it's pumped up a lot, it is generally overstated or overstating the implied move of that underlying. Does that make sense to everybody so far? This is why we want to do high implied volatility, because it gives us a lot more room for the break evens and allows us to get a lot further away from where the underlying is trading. So the essentials to success on an Iron Condor is going to be picking the right strike. Now, what's the right strike on this? I always look at one standard deviation move for just about every strategy I do, and then try to move it out from there. So the one standard deviation move is around an 84 to 86% probability of being out of the money, or around between a 14 and a 16 delta is usually where I'm looking to start my short strikes on the call side and on the put side. So that's where we're going to start to look at for these strategies. And we're going to be looking at picking the right duration. Now, right now, we are in a bit of a flux where we're at 28 days on the March contract, and we're about 56 days on the April contract. Now, when it's like this and we have an expiration coming in with February, today's expiration Friday, it's really a coin toss in my eyes where we want to go. I want to see this theta decay coming in, but on the other side of the coin, we're going to get a lot more money and be able to be a little bit further away from the at the money strikes when we're further away. So it's just going to be a coin toss today. You know, in the end of next week, for sure, I would be looking at April for these. But going into today, you know, you're going to have to look at it because the April contracts for some of these underlyings won't come into effect until Monday. They won't even put those out there for you, so you won't even have the option to do that. So then obviously you're going to have to default to February. But the reason why we want to do it between the 45 days is usually the optimal in my eyes. But when we don't have that 45 days and 56 days is about as far away as 28 days, you know, you look at this slope and you can see it really starts to pick up. And 50% of that theta decay, which is the time decay, comes out of those options right here, right now. So when we have this theta decay getting kind of held up and going into this, the line is probably a little bit higher when you have the higher theta or higher volatility, I'm sorry. So it will be more pronounced on the downslope if the volatility starts coming out. So that's what we're looking for. We want volatility to have held up a lot of pent up theta decay, and when the volatility comes out, that theta really starts to happen rather quickly. And we want to pick the right environment. What's the right environment? I've been mentioning it several times. It's that high implied volatility percent. 57, I'd look at implementing the Iron Condor when current IV percent right down here is above 57%. You may ask, how do we get that 57%? I'll go through the math a little bit later when we have a chart, but basically it's where the current implied volatility is minus the low of the last year, and you divide that by the high and the low of the last year. And I'll go over that a little bit more detail a little bit later on. Excuse me. And we need to pick the right underlying. You know, we don't want to pick something that has, you know, 25, 30 cent wide markets unless we're going into something like Amazon or Priceline or Chipotle or something like that. Obviously, those really big stocks, 500 or whatever, are going to have a lot wider bid ask. The problem with having a wide bid ask right now is that when you're doing multiple legs here, you're having to give up a lot more edge to get in and out of this strategy. And when you have to give up a lot of edge to get in, and then you have to give up a lot of edge to get out, that eats up a lot of your profit. So I just stay away from, you know, just the oddball stocks that not a lot of people are participating in. And how do you figure out? Right here, look how many, this was yesterday, I think I took this screenshot, and you can just see at the end of the day, that's a lot of contracts being traded, and you can see the bid ask on Walmart being a $50 stock is, you know, less than 5 cents wide. On a $50 stock, I don't like going more than 10 cents wide for all intents and purposes, unless I really like that stock. Then I might bend that rule a little bit, but that's what you want to look for. You want like 5-10 cent, somewhere between 5 and 10 cents wide, and really start to shy away from it going outside that, because once you do 4 different legs on this, you know that you're hitting the bid here, you're lifting the offer here, and you know it's doing the same down here. So you're giving up a lot of pennies, and a lot of those pennies will make a big difference at the end of the year if you've been getting chopped up that way. And know the exit. What I look at for this strategy on the Iron Condor is I look for 25% of my max profit. So if my max profit, let's say, is $1, then I'm going to be looking at taking 25 cents out of this trade before I close it, if that's within 15 days. So 15 days and under, if I've achieved 25% of my max profit, I'm closing it. And as you guys know, if you watch several of these, I know I can see a lot of people have are been returning. 50% of my max profit is where I'm looking at. I'm not going to take this all the way down to the last penny. There just is way too much risk in it. And with the Iron Condor, it does take a bit more time to have that premium decay, because you're kind of picking a range bound on this. So obviously, if the market goes up, your puts are going to be worth less than they were before, and your calls are going to be worth a little bit more. So that has a tendency to counteract each other. So in that, if you can get 25% of your max profit within 15 days, I'm usually looking to cover that. And if I get 50% of my max profit, that's where I'm looking to take this trade off. And the reason why I do that is there's other fish to fry. Get in, reallocate that money somewhere else. There's probably a better opportunity. The volatility on this has probably really decayed. If you've gotten 25% of your max profit in 15 days, that means you've gotten a little bit of volatility crush in there, and there's just too many other risks in there. The closer you get to expiration, you start having gamma risk. The delta's closer to that, the money starts spiking, and all of those types of things that you really don't want to influence this strategy. And your max profit is going to be the net premium you receive minus your commissions. Anytime you're doing a credit spread, it is the net premium you received. And your max loss, remember, you're going to have 2 of them, but only one of them is going to come into effect, because you can't have your puts go in the money and your calls go in the money at the same time, right? So your max loss on the upper band is your long call minus your short call minus the net premium received, and on the bottom band, it's your short put minus your long put minus the net premium received. So those are going to be your max losses. So basically, it's your net premium minus the width of the strike. So if you collected $1, you have a $3 wide strategy, then you're risking $2 to make 1. And when you're selling option strategies, your higher probabilities are the ones where you're risking more than you are able to make. The closer you get to it, you might get 50-50, like on a $3 wide. If you're collecting $1.50, that means your risk reward is 50-50, which means you have a 50-50 chance of being profitable. And your break even is the underlying price, or the underlying price when the short call plus the net premium. So you add your net premium to your short call, or your short put minus the net premium. So on the downside, if you were doing the, let's say you had the short 50 calls and the short 40 puts, and you collected $1, then 51 on the upper end would be your break even, 39 on the downside would be your break even. All right, enough boring you guys with the slides here. And somebody did ask if they could get a copy of the slides. Other than from this, we don't usually send out the slides, because I spend the greater part of my time with the platform. Excuse me. So I was looking at LinkedIn a little bit ago. LinkedIn, as you can see, well, they were a lot tighter earlier, but it's $100 stock. So 20, it's usually about 10 to 13 cents wide. It's gone a little bit further as people cancel and go away for the weekend. But, you know, it has right down here the high IV percent. And I always put it over here in my market watch also, the IV percent. So that's the first thing I look at for any strategy. And then I start looking at like the charts. Another thing I don't like about LinkedIn is they came out with better than expected earnings and tanked, and I'm not really sure why, but I haven't looked into it that much. But it took a massive drop. It looks like it's pretty range bound now and may have settled down, but I'm always weary when you have this big of a gap, especially when they beat earnings, that this market's going to want to kind of trend higher, and I don't really want a higher trending stock when I'm putting the strategy around it, because it's going to be really hard to get outside of that. Yeah, well, somebody's asking about the monthly service. Yeah, we'll have a link at the end. It's in the chat box actually, I think right now, but there'll be a link. We'll talk about that in a little bit too. Because yeah, I do daily market commentaries. I talk about what I'm doing daily, what I see is going on in the markets, whether it's economic, geopolitical, or just different stocks and the trades that I'm doing daily. So this one would probably not really fit. And please, you know, hit me up in the question box. You guys want me to look at a couple of stocks? I like the back and forth. I want, you know, I look through, you know, tons of stocks, but there's some that I'm sure I've missed also. So please reach out to me. Another thing is, you know, there might be stocks that I have positions in. So, you know, keep that in mind. I'm not just trying to do a stock that I want you guys to invest in because I'm invested in it. It just may happen that way. So please keep that in mind. All right, so triple Qs, okay, good. Everybody's pumping some up. So first, I'll start at the top here. So somebody threw out ABX. So ABX looks like it's been cruising pretty high. And as have all the I think it's miners, right? So look at ABX. They have pretty tight markets. You also then go to what the volume has been. As you can see, this one definitely fits the bill. It's above 58. That would be a pretty good one. So you know, we can look at that and go to, I'll default with this one because I see the next one coming up and I know I have a position in March, so I'll just look at April for that one. Do you find stocks safer for Iron Condors than ETFs? I wouldn't say that it's any safer. As a matter of fact, I think ETFs are probably safer just because it's the basket, you know, and if one really spikes higher or lower, it doesn't really necessarily affect the overall basket. With ETFs, I generally will lower that IV percent, the current IV percent, to about 30. I'll go, you know, down to if it's around 30 for the ETFs. If it's an individual stock, I pretty much have a hardline rule that it needs to be around 50. You know, 49. If it's, like I said, been just trending sideways and it's at 49, and I'll probably bend that rule just a little bit depending on how far away I can get from those. But now with ABX being a smaller stock price being 12, it could be a little bit more difficult, but let's look at the deltas. So with the deltas, I usually try and look at implementing this, like I said, around 16. There's not one here. 20 is good also. It's going to put us pretty close to at the money on this for the 12s, even though that's had this had a pretty big rally, so I don't know if I'd want to really test it, although it does look like it could be topping out. You got the double top here, pierce through it, but then you got that spinning top candle right there. So it could look like this might be a candidate where I would look at it like, since this looks like a top to leg into this Iron Condor, where I'd sell the call spread first, I'd wait for it to come off, and then maybe add the put spread to it a little bit later. I don't normally do that. Usually the strategy that I enter the trade with is the one that I like to keep on it. But in this regard, I would go to this 20 delta and then buy the 10 delta. And since we're $1 wide, we're going to at least want to get a about 25 cents for this. So then I would look at the 21 here, and we're not going to be able to get there, I don't think. Well, maybe it'll be close. So 28 cents. So that's about, you know, that's very close to a third the width of the strikes. That's what we're looking for here. For a $1 wide strike, we want to get about 33 cents for it. So during the day, I might even pump that up to 31 and see if I can get that, and then 32 maybe even, and just leave it in there for a little bit and go on searching for something else to see if I might get hit on it. But for this one, it's pretty close. So the only thing I would worry about is the fact that it's had that big run and it might want to come off rather quickly, being related to the gold. So you know, you could even go out to April and see if it gets a little bit better for you and see if it's worth it. So I'd look at this probably 19 and then maybe even skip a strike. So we're looking at a $2 wide here then. And I'm going a little bit wider on this just because I want to get inside of that. And $2 wide one, I'd probably want to get around, you know, that's pretty close, 33, so about 30 or 45, 48 cents or something like that off the top of my head. But that one looks pretty good. So 10 to 18, we had to have 10 to 16 on that, and then I'd go back, so 10 to 16. So 16 is pretty high up there, and 10, yeah, because I would think that this would act as support somewhere along here. You might even want to just throw on some Fibonacci's just to see what that does. So yeah, 10 would act as a nice support if it did come back down there. So that might be a pretty good one. It's probably going to want to bounce off of this, and my 16s are so far above that that's kind of nice. So that one would definitely fit the bill. The other thing I wanted to talk about is normally Iron Condors, you kind of look at like $1 wide. The further out you go, the less you're going to be able to collect. Like for a regular Iron Condor, I like to say, you know, is about $1 wide or something along those lines, maybe $2 wide. Collect a third the width of the strike. And on the floor, then we used to call it a big condor. And a big condor doesn't really mean anything other than, yeah, I don't know how to say it with being politically correct and everything else. But anyway, a big Iron Condor would be something where you're like $5 or $10 wide. And in that case, then I'm going to be looking at probably collecting a little bit less, maybe 20% or something like that, the width of the strikes, which still gives you about an 80% probability of success on that. So, you know, the more you're risking, the more your probability of success is. And the thing is the further away from, the more risk you're taking on this, the more it acts like a strangle, and strangles will decay a little bit faster than the Iron Condor because of the defined risk nature of that. So keep that in mind also. So you can widen it out, and we will go into that a little bit further because A lot of the stocks that I had like 10 stocks or 15 stocks written down on here at the beginning of the week, and I've slowly kind of put lines through them because they've gone below that 50% implied volatility percent. And speaking of the implied volatility percent, we have purple here, which is the historical volatility. I really don't usually look at that. That's kind of left over from the Volatility Crush webinar. But to figure out what your implied volatility percent is, the way that that number is figured, is you take this current where it's at right now and subtract 56 minus the low, which is 4, and then that is on the numerator, which is the top of the division table, and then you take the high minus the low on the denominator side, and then you divide those two by each other. That's where that number comes out. That's how it gets that percentage. And that's basically where it is trading now upon itself in the past. And I will have a tendency, let's just look at this real quick, EEM, which is the emerging markets. See how you get these massive spikes every once in a while? So you'll get this in some of your stocks, and that really throws off that implied volatility percent, which is why it's important to know the math behind it. Because, you can have, since it's it happened twice, so it's not necessarily really an outlier. It happened in that August and then just recently. But if there is a stock where you have that major outlier, you could say that this was the top. I do that sometimes where I'm like, okay, there is an anomaly there. I'm going to discount that because the computer doesn't notice that. It just knows the high and the low. So I might take that out and make this say the high, the 62 rather than, the 100 there. Does that make sense? That's why it's good to know that. And Fred's asking, do I let you know if a position is against me, and when you're buying it back? Absolutely. I even tell you when I'm defending it. So for instance, in these daily market commentaries, Twitter, I've been getting beat up on, right? I mean, I shorted the 21 puts in Twitter several months ago, and we all know what Twitter's done. It's just done nothing but gone down. Well, I have rolled those puts, and they're naked puts, so they've been really beating me up. It's not a defined risk strategy, but I've been able to roll those puts out so many times that I've collected enough premium that even though this position is still against me, I'm actually at break even right now, and I think Twitter even rallied a little bit today, so it put me above break even, and it's been able to keep that dream alive. So yes, I do talk about when I'm in, when I'm out, why I got in, why I got out, and I even tweet out stuff. So like for the earnings trades, I like to go at the end of the day. I do these market commentaries in the morning. So if I'm doing an earnings trade, a lot of time I will tweet that out and say, hey, I'm in this earnings trade. So you guys can follow me on Twitter at Wolfman's blog, or just at Wolfman's blog, and you can see that stuff too. So, and some other snark that I like to throw out there every now and again. It's not all market related stuff, but so yeah, I try and keep you guys abreast as to what I'm doing. If I lost money on it, if I made money on it. You will notice that if I'm losing money on a trade, I get very defensive with it and try to put other things on it. And as a matter of fact, in a couple of weeks, on Monday, I'm going to try and put on about 5 of these Iron Condors, and I'm going to keep you guys abreast of that. And then in a couple of weeks, we're going to be talking about how to defend it, because not all of these Iron Condors are going to be hunky-dory and just make us money. I'm assuming only because of the probabilities. If I put on 5 of them, at least 1 or 2 of them will probably force me to get a little defensive with it. So in a couple of weeks, I'm going to talk about all the rules that I go through and the steps that I do that. So that'll be really important for you guys to pay attention to, and I'll most likely be talking about that in the daily market commentaries as well. But EEM is another one that I actually looked at because it does have pretty high implied volatility percent if I knock out those two two little outliers, and it is an ETF. It's above 30%, so it's kind of a little understated if I knock out those other ones. And in this one, for instance, if I was going to do this, I'd probably go to this 18 delta, which is, you know, really close to 16. You know, I said 16, 20-ish, 14. You can look at that. They're not giving you very much money for those right now. But if I, oh, it's 50-cent wide. So can hit that. I'm probably going to get 10 cents. And usually the puts are the ones that give you the most money because that's the fear indicator to the downside. So you can get a little bit further away even. And I'd probably, so what am I looking at here? I'm looking at the 33, somewhere between 33 and 27. So what I'll usually do is go back to the chart and look at this. 33 is up here. And 27 is very close to the lows. So that one would look like a pretty good area to put that on. So the 33s, if I sold those, bought those, I'm not going to get any money for this, or the 27s. And when I'm building this out, you guys, when I'm clicking on the buys and the sells here, you hold down the control button, and that's what allows you to build it out. I don't know if you guys know that or not. 21 cents. That's a little bit lower than what I would like to see on that. So EEM, I would maybe keep that in mind and move on with EEM on something else. The one that I did put on was in Adobe. Oh, somebody wanted to look at QQQ real quick. So the QQQs, I actually have a short put spread on, or a short call spread in there that I'm getting tested on since this massive rally we've had. Thought that was golden. I didn't see us rallying as much as we had. I thought it was going to be a slow drive up, but it's an ETF. Again, it is above 30, which fits the bill. We have had this pretty big volatility crush, and again, that August massive spike that we had, I'd probably look to discount that from my IV percent figure. Again, you take where it is now minus the low on the numerator and divide that by the high, which I would say this is pretty good representation of the high, somewhere around 67, 68, and on the denominator, and subtract that by the low again and come up with that percentage. So it's probably a little bit higher, probably closer to 40 some odd. And the Qs, like I've talked about, we've had this big pop, came down, came up, and I could see us settling into a bit of a range for at least the next couple of weeks before we really decide what direction we're going to go in, unless maybe the ISM numbers come out and something crazy happens there. But I could see us kind of chopping back and forth on here. So in the Qs, I would look to do, again, go out to like the 20-ish, 17, and play around with it. So these are the ones I usually pop back and forth on. So with the Qs being the 108s and the 93, so 108 to 93, and I would come up here and look at this 108 area. You know, that's a comfort zone there, and the, you know, the 93s would be breaking the new low. So we are in a bear trend, and that would make me nervous because we haven't been able, you know, we've made a lower high and a lower low. So that would make you think that it could want to move to the downside. So if it goes below the 94, those 93s will surely be tested. So I might just bypass the Qs for something like that. The one that I did like was Adobe, and I put this on because, like I said, I kept scratching them out day by day, and I was like, oh my gosh, I'm not going to be able to have a trade on by the end of all this because everything's got the volatility crush going on. And Adobe, the only reason why I did it because we have high implied volatility. It allowed me to get pretty far out. So I did this as what I would call a big boy, because I ended up going $5 wide, and that starts being a pretty big big boy strategy, if you will. And it, you know, like I said, the markets in here are tight. That's 5 cents wide there. And with Adobe, so I went $5 wide and was able to collect about $1. I think it was $1.21 for this strategy. And I did it small. So the wider you go, the smaller you get. So if you're used to doing, you know, $1 wide, $2 wide, or $2.50 wide, or something like that, strategies for the calls and the puts, if you go further out, do less size, you guys. So with this strategy, I would half, and the further out, you know, if I doubled the width of what I would normally do, then I would go half the size of what I would on the tighter strategies that I'm not willing to take as much risk. So the tighter it is, the bigger I go, and the wider it is, the smaller I go, because you're collecting a lot more premium for it. So you want to reduce your size a little bit, because you're taking on a lot more risk also. You know, I got $1.25 out of that, so let's just say $1.25. I think it was $1.21, but $1.25 for math purposes, I'm risking $3.75. So if we do the math on that, that should be, if you take your $1.25, so I'm risking $3.75 on I must have collected more than that. Sorry, $3.75 divided by 10, so 37% probability of success. There's no way I got that. So anyway, what would I have gotten on that? Or close to it anyway. Oh yeah, it's only a $5 wide, that's right. Sorry guys. That's why my math is off. So $3.75, let's just say, divided by $5 wide, because that's the $5 wide strike, right? So $3.75 is my risk versus the spread. So I have a 75% probability of success. That's how you figure out your probability of success on something like that. Okay, so I'm being asked, do I go by percent distance away? I usually, yeah, in a sense, I look at percent of being out of the money, so and or the delta. So I'm usually looking at about, I usually go about, the wider I go, so on this one, I go for the 20 and the 10s on the big Iron Condor, as I call it. But if it were a regular Iron Condor, I would probably have gone with the 15-10, because I would start with the 16 delta on the regular one, and on this one, because the puts were pumped up so much, I went with the 16. So it's not always, you know, going to be exact. You know, it's not an exact science, and I was able to play around. And as a matter of fact, I think on this one, now that when I was playing around with it, I punched in the numbers, and I was getting too much for my put side, so I was able to move that down, these two strikes down by one, get further away, and still, you know, and get right there at my 75% probability of being profitable. Usually, you know, if you're collecting a third the width of the strike, you're looking at about a 67% probability of success on it. So, you know, you can do the math on it again here. So if I'm risking 67 cents divided by the dollar, that gives you 67% probability of success, right? So you take what you're risking and divide that by the width, and that gives you your probability of success on that strategy. So that's why I was able to move. I might have even been able to move it down a little bit further, but I then went and looked at the 80 or the 90, 70, and the 90s are way up here. So the brilliant of this in the 70s would be making a new low on Adobe. So, and that is, a double bottom, which is going to act as a very strong support. You got a double tweezer bottoms there. That acts as a very strong support. So, that's why I was very comfortable with those 70s. And then the 90s would be up above where this little trend was. So that's going to act as support. And again, we could probably throw up the Fibonacci just because a lot of people look at them. And I'm probably thinking it's going to, and Fibonacci is very close, 6D, and of course the low. So the 90s is going to be a Fibonacci level. So that in and of itself, you could easily see it wanting to bounce up against these. I've got several lines of resistance to my upside, and the tweezer bottoms, and the 52-week low being right down there. So that's another reason why I jumped on this really quick to get this on before Monday happens, because I could see Monday happening and I lose a lot of my vol, and I didn't want to have that happen. So just jumped on that one a little early. But that's the big Iron Condor, because normally you'd go like I would go $1 wide or $2.50 wide. This one I went $5 wide. So we would call that like a big Iron Condor. Does that make sense to everybody so far? So let's look at another one. Another one I was looking at was, and you'll be able to see when you look at these applied volatility percents. See, everything's starting to really come off. XOM was another one, ExxonMobil. It's had a nice rally. I think that these oil companies are going to have a bit of difficulty going forward, but they've seen a pretty good sell-off, a rally back. I could easily see it dropping back into this area here. So look at the IV percent, and this was at like 53 when I started looking at it. And you can see it really kind of dropped off today even more. So from just today, it really came off about 3 or 4 percentage points. The other one I was looking at was Starbucks. And the reason why Starbucks was because it was right within these Fibonacci levels. So, if my theory is right, things are going to want to kind of bounce back and forth, and those are going to, it's right in the middle. So, if it's up against this Fibonacci level, it kind of makes it a little bit difficult for me because, or just pierced it, because it could want to pop a little bit higher. Again, it's had a lower high and a lower low though too, as everything has had, but in the implied volatility really came off today. It's down to 47%, so that's another one I would need to scratch off. So as you can see, a lot of these are coming off that I had. Does anybody else have any other ones that I could look at real quick? I got a couple questions popping up. The big dog at $5 is played only because IV is pumped up. Otherwise, say yes, because the IV was pumped up, I'm expecting IV on this big dog Iron Condor. I like yours better than the big Iron Condor. Maybe I'll rename it for myself. But let's call it the big dog Iron Condor. Yeah, volatility is really pumped up. I'm able to get a little bit further away. But, as long as volatility is pumped up, it's kind of your risk parameter, right? And I planned on putting several of these on and doing different strike levels. And that one kind of really fit nicely with everything I was doing. So I'm going to try and find a couple more. I was hoping XOM, Starbucks, EEM, and Adobe, and ADM was another one that I was looking at. Oh, and EA was another one I was looking at. It has 52%. And this one, since February is going off, EA is going to get new options on Monday, and it'll get the April options series. So that was another one that I'm looking at for putting that on for the Iron Condor. So stay tuned for that and keep your eyes out for it. The reason why I like this for the Iron Condor, as you can see, it's really gotten settled down into a nice trending area. This should act as resistance and support. So I think now that Christmas is behind us, EA Sports is probably going to start trending sideways for a little while. It got, everybody was talking about EA Sports and all their new signings and stuff like that, and it was going to be on the covers, and that causes a little bit of volatility too. I can't remember, I think they beat earnings. Yeah, they beat earnings, they sold off, so it could easily just start to trend sideways there. Do have a little bit of cross there, but SK, getting a couple more. TLT, Mike likes TLT. Stepping in front of a train though on TLT. As a matter of fact, I was short TLT and just covered it, but yeah, TLT, I don't think that the Fed's going to do anything. I didn't think they should have done anything the last time, but if anything, they might lower rates. But I mean, this is a historical high for bonds and TLT for that matter. So if you haven't refinanced, I'd really consider refinancing too. But TLT would be a good one. I think it's come off, but I bet it's got a, their implied volatility percent is 43. So I might shy away from that a little bit, just because it's well below 50, and you can even look on the chart and see that it's really had the massive vol crush. That's what we call a vol crush right there. Just in a couple of days, just everything got sucked out of it. And my TLT trade on, I think I had it only on for 3 days. NOC. That is nice trending. It doesn't have any vol though. You can just eyeball this and see it's probably around 25% IV percent. Yeah, 25, 27. What was your other one? SKX. 30%. See, those are way too low for me to do these types of selling strategies. I mean, I wouldn't even look any further than on Skechers for 30%. Just a no way. There's just too much risk to the upside for that to have expand on me. And GLD might settle down. I agree with you. So GLD 67. I mean, it's had a massive move. Might want to try and come and cover that gap there, but so yeah, I don't really have a market direction on GLD necessarily. So again, I would go out here probably to let's see, this is looking like I can get both deltas at 17, so I'll be relatively delta neutral, which is what you kind of want to do also. So $1 wide. Ooh. So I might just go to the 19 because on that one. Just because, as you can see, those are way too close. So then if I went to the 19 there, trying to say relatively delta neutral on this, do the 21. So did a dollar wide and we got 33 cents for it. So that would definitely work. ER. Yeah, I looked at Lowe's. Their problem is as you can see, like GLD being 117. Look at how tight these markets are for the most part. I mean, and you got to remember people are falling off and not leaving their bids and offers in there. But 3 to 5 cents. Usually this is going to be inside of well inside of 10 cents. But if you look at Lowe's, and are you thinking L or LOW? for Lowe's. Lowe's usually has kind of wide markets for what I usually look at. So, but it's inside of 10 cents, so I would definitely consider it. But they have earnings coming up. So Lowe's wouldn't do it. I wouldn't want to put this Iron Condor around Lowe's days in advance. I have done a webinar on earnings trades. So Trevor, if you're really interested in Lowe's, then you could look at that. My minimum or maximum credit on these, I look at, on the big dog, getting, 25% of my width of my strikes. And on a regular Iron Condor, I look at 33% the width of the strike. So somewhere right around in there. So that's why when you see me looking at it, I go to about the 16, 20 delta-ish and start from there and play around with it and start mixing and matching it and see which ones work the best to get my probabilities right around, 75 to 67% probability of success on that. And remember, the way to figure out your probability of success is take your risk, divide that by the width of those strikes, and then that gives you that percent that comes up is your percent probability of success on that. So remember, when I was talking about trying to put 5 of these on, if I'm looking at 75% probability of success, I am going to be looking at, 1 or 2 of these being the one that's the problem child that, I'm going to spend the most of my time trying to play around with. That's the thing with trading, is you have to remember that your probability of touch, like being tested on these strategies, is 2 times the probability of it being in the money. So your probabilities of being in the money on something is, what your delta is. That's your, it's a 5%-ish probability on a ballpark of being in the money. So my probability when I'm doing a 20 delta, my probability of being touched or tested on either side is 40%. So, it's almost a 50-50 chance. So you got to keep that in mind. And remember, your probabilities of when you put this trade on of being in the money are what you have to look at. And remember, you're going to be tested on just about every strategy you do. And it's probably even better than, especially with the volatility we've had, better than 2% or 2 times the probability of being touched. So I've had several of my strategies get tested thinking that I was looking at a max profit on them, and now that we've popped back up, those strategies are looking good because they've come back and are now out of the money, and I've had that volatility contraction and everything else. So everything's kind of culminating right now where I have a lot of strategies on, and now they're all starting to work out relatively nicely. I did look at Lulu earlier, and Lulu's thing is Lulu's had a lot of rumors flying around with them, and that's what's caused a lot of this market gyration. Every time somebody says Under Armour should buy them, and then are not going to buy them, or somebody's going to buy them out, they've had a lot of movement. It does look like that it's starting to settle down, though. You get this boom boom hop, and it's kind of like the jumping bean, right? And now it should maybe start settling down. The IV percent on this is looking like it could be right around 50%, 48%, yeah. So yeah, this would be a candidate, and you could look at, you're doing a $2 wide, so, or $2.50 wide. So control, oh, didn't give me my first one. So 67.5, and then I'd look at the, we're on the 18 delta, I guess, since sell that, and then So 61 cents, $2.50 wide. I really want to try and get closer to about 80 cents on that for a $2.50 wide one. So I might have to move these calls down. Move the calls closer. 69. Oh, there's not a 69 though, I'm sure. 65. And then move these down also. See if I can get some. So 85 cents. So that would be the ones that you'd have to do on that. So 67 to 52 and a half, 67 and a half to 52 and a half. 67 and a half is quite high, so that looks pretty good. To the 52 and a half. See, the thing is I bet if I put Lulu up on market profile, oops, that's not what I wanted. I didn't mean to close that out either. Again, a couple questions. Let's get to the questions real quick. So Lulu would probably, those would be the strikes that I would look at for Lulu. I think it looks pretty good for that one. Who asked? I got a bunch of questions popping up. Go 2 times the standard deviation and relax more even for the weeklies. Oh yeah, so great question, Peter. One thing is with the Iron Condors, I stay away from weeklies on this unless it's an earnings trade. So stay away from that. Go to the closest to 45 days on this strategy. Stay completely away from the weeklies. I had that in my notes and forgot to mention that when I was talking about the theta decay, but stay away from the weeklies with the Iron Condor. Would it be better to do this on futures? You could. I mean, I have done this on futures contracts, say for instance, /ZB or, but you remember, you know, that's a bigger contract. So if you're usually using TLT and you're going to the bond futures, then reduce your size dramatically for that. Like the E-minis, yeah, same thing. If you're doing E-minis instead of SPY, reduce your size for that. IV percent 48, okay. It is okay if you really like it. Like if it's really started trending nicely. I mean, of course, you know, you're going to get implied volatility expanding around a major market move. So if it's been trending nicely, like I said, I will bend that 50% rule. I would not do it if it's been trending nicely at 30% IV percent because it's just there's too much risk for it to expand on me. So in that regard, I do bend that rule if I find a stock that I really like. But I stick to my guns on that. I wouldn't want to do it where I just wasn't collecting enough money to get to that, you know, third the width of the strike or so. Does that make sense? So yeah, so place it as close to 45 days to go, and if inside of 15 days, so you know I've only held this on for less than 2 weeks, I'm at 25% my return on investment, then absolutely I'm closing it out. And if I don't get that, I ride it out to, you know, to get my 50% of max profit, and usually that happens right there at 30 days, inside of 30 days. So that's what I'm trying to look at for that. Absolutely. Does anybody else have any questions for that? Right, 50%. Anytime I get 50%, I'm out. So especially if it happens within 30 days, for sure. What happens if the price goes in the money quickly? Would you get out or wait and maybe the price would bounce back in the middle? I usually will wait a little bit, and if I do get really tested on it, and I'm going to talk about this in a couple of weeks, that how to defend an Iron Condor that goes wrong. So stay tuned for that one. That's going to be we're doing this as kind of like a 3-part series. So the next webinar is going to be on iron butterflies, which is kind of like the straddle So this is the strangle with defined risk. It's going to be the straddle with defined risk. And then on the one after that, I'm going to be talking about, because I wanted to get a couple of weeks, because in between this one and the defending the Iron Condor. And it's going to all tie together, you guys. I'm going to make sure it all ties together and show you how it all does tie together for you. Can you scan search for above 50% IV on toss? That's a good question. I don't think you can, other than putting it in your watch list, and basically you just go up to the gear and punch on it and then type in IV percent, okay? And then that's about the best way to do it. And then I always put it on this watch list, and that's how I scan for it for the most part, okay? Sorry, my dog's stuck in a cage and getting a little cagey, I guess, or somebody's at the door. Sorry about the background there, guys. All right, that's about it then. So we went over how to build this out. Yeah, getting hungry. How to build this out, and we're going to go over how to defend it later on in another webinar. But we talked about the different deltas, the price we want to get, and everything else. One thing I always say is, if you are new to this strategy or you're new to options, watch this again as soon as you guys get this in your email, and because the first time through, some things are going to blow by you, and the next time through, it will put it in your long-term memory. If you wait like a month down the road, the different nuances of this strategy are going to get kind of forgotten. So watch it again so it really sticks in there. All right. And like I said, we mentioned a little bit earlier, the membership trial. You get these daily market commentaries that I was talking about, where I do it daily. I talk about trades I'm seeing, trades I'm putting on, the trades that I've taken off, whether it's a win or a loss, and other geopolitical stuff that I'm talking about, whether I see, which direction I think crude might be going because of, what Iran's doing, or if OPEC is going to try and shut off the spigot, let's say, or, what Merkel's saying, or yelling about. So you get that. You also get the lesson videos, which is about these strategies, but like more 15-minute just refreshers, so you don't have to watch a full-on video. I kind of go through it rather quickly, but I don't get in as much detail as you would see in these trading workshops. So there is a link there in the chat window, and you can click on that to get the membership for it. And one last question: do you get worried about some of these Iron Condors going south on you because of massive stock moves? Would you simply just close the losing leg for defense? No. The reason why is because I'll talk about that in another webinar. Like I said, I don't like to close anything for a loser. I usually will try and roll it out in time, keep that dream alive, unless something major happens. For instance, all of a sudden oil, if I were to do this around, say, USO or crude oil /CL, if I saw something different happen that would really affect that, then I probably wouldn't. I usually, because it's a defined risk strategy, will write it out. I made my bed, I'm going to lay in it. But there are ways to increase your credits, and I'm going to talk about that in this three-part series. I just didn't have enough time to get into it all today, but guys, keep your eye out for that and sign up for these next ones, because that's what we're going to talk about going forward on defending these, because that's going to be the big make or break on the one that you're going to be losing on, right? So it's going to be really important, because you are going to be tested on this. So it's going to be important for that. All right, and that's about all I got for you guys today. I just want to say thank you to all you guys for participating. I love the back and forth. I love that everybody, throws their ideas out there. And, when you guys give me some of the ideas and things that you guys are looking at, it helps me go through the process or show you the processes I go through realistically, rather than just all these slides that we flip out there, all that it needs to be done, but it doesn't really show you the step-by-step process that I go through. And that's exactly when you guys are throwing those out there. That's what I do. I look at the IV percent, then I look at the spread to see if I can get my my width or my receive enough credit for the width of the strikes that I'm going through, and then I play around with them and move it and change the deltas and move that around to come up with the right Iron Condor. All right, so in later webinars, we're going to be drilling down on option components and how to trade them. Like I said, next week's is going to be on the Iron Butterfly, which is similar to the Iron Condor, and then the following one from that is going to be where we're looking at defending these and how I may have defended those different Iron Condors that I'm going to be putting on Monday. So check out Monday's market commentary. I'm going to throw some of these on there and try and find 4 more. Since I did Adobe, I'm going to try and find at least 4 more Iron Condors and hope that one of them, never really said that, hope that one of them tests me so that it makes our defensive webinar that much better. So thank you again. You guys can go to that chat box. Like I said, you get to sign up for the offer. Go to Pro Trader Strategies. And another thing is, if you guys are signed up with me on these, our member, reach out to me if you guys put on a strategy. Maybe it's not Adobe or something like that. You put it on an Iron Condor and all of a sudden you're getting nervous. Reach out to me via email and I'll talk you through it, what I would do. Like I said, I can't tell you what I think you should do. I can tell you what I would do given that certain situation. And you can contact us at 310-598-6677. Thanks, RJ is going to sign up, King of the Wolves. And thanks to Rick. I'll tell Ricky you said hi, for sure. So appreciate it all. You guys have a great weekend. And remember, the big dog Iron Condor. If you can't take that, take it easy. Take care, guys.